The Federal Open Market Committee, FOMC, is scheduled to meet next week, which may trigger another surge in gold prices. Rate cuts from the Federal Reserve are widely anticipated. Biggest moves in bull markets, and this is true for gold as much as any other market, are historically down. In a bull market, like in any other, the largest movements are upward. Reason being, market participants are attempting to deceive investors into thinking that a market upturn or downturn is imminent. And in gold's case, it's a bull market, and these sudden dips are meant to frighten away the less experienced traders, those who may have just entered the market recently, so that we can rid ourselves of the dead weight and excess baggage before we soar to new heights. The recent fall in gold prices is being misread as a sign of weakness, but the bull market in gold is far from over. These kinds of sharp declines are the market's method of removing short-term traders and gauging their level of confidence before continuing its upward trajectory. Aiming to shift wealth from vulnerable to powerful hands, every significant bull run in history has been accompanied by unexpected dips that throw investors for a loop. As confidence in the dollar's long-term stability declines, central banks are selling off U.S. bonds and buying up gold at record levels. This continuing monetary change is based on that consistent demand, even though mainstream analysts see it as just profit-taking. This correction is not the end, but rather a reset, according to experienced economist and founder of Euro-Pacific Asset Management, Peter Schiff. He cautions that individuals who sit on their hands run the danger of missing the next explosive leg higher in inflation, rate cuts imminent, and gold's $4,000 bottom. These downturns, in his view, are opportunities to stock up before the influx of institutional capital comes rushing in. The excerpts from Peter Schiff's interview are now presented. Prior to proceeding with the discussion, kindly subscribe to our channel and enable the bell symbol to receive timely updates. Take pleasure in the video. I'm grateful. That we received a correction is a negative, isn't it? A number of individuals hastened in, and now we have a retraction. Because gold's rapid price increase did not occur until relatively recently, that is likely to be considered the past 2 weeks rather than the past 4 months. However, I do believe that investors are starting to take an interest in gold because we are seeing inflows into gold ETFs, and these inflows are big. Neither they nor enough of them are interested enough at the moment. However, they are now beginning to see the light and are beginning to purchase gold, despite their initial lack of enthusiasm. In my opinion, that bodes well for the future of exchange-traded funds, ETFs. I still do not believe that the money that has poured into ETFs in recent months has run its course, and I do not believe that the enthusiasm that gold's recent dip from 43 to 4100 provoked has evaporated. In my opinion, that's just the beginning. With our substantial funds, we will be able to follow up. Of course, some short-term leverage speculators might have lost money due to being caught unawares by the sudden and severe drop. It's certainly doable. This, however, is par for the course during a bull market. Even though I've been saying this for a while now, the largest price movements in a bull market, and I'm not limited to just gold here, are downward, and vice versa in a down market. Reason being, market participants are attempting to deceive investors into thinking that a market upturn or downturn is imminent. Additionally, the gold market is experiencing a bull run, and the point of these sudden dips is to frighten away those who aren't as strong, like newcomers to the market, so we can get rid of their dead weight and superfluous baggage before we reach new heights. However, it seems like this is the pinnacle according to the media. Please leave. It would be completely unknown whether this was the peak. That is the standard method for making tops and bottoms, you know? When you're far down, you don't really appreciate how high you are, do you? Neither the top nor the bottom of the market ring a bell. Therefore, the gold bull market does not end with a sudden and dramatic decline. No, steep declines like that indicate a healthy bull market. This one correction is all it needs. It goes without saying that the market was becoming overbought, not overowned. Since very few investors really own gold, the term overbought is used in a technical sense. Both ordinary and institutional investors own a historically low amount of gold. Because of this, a substantial increase in revenue is anticipated. Also of great importance is the fact that the purchasing by the central bank is far from over. They continue to be purchasers. Someone is driving their purchase. Their gold reserves should be augmented. Their holdings of US dollars should be reduced, which means this will take place regardless of how much gold costs, correct? They aren't just purchasing gold to resell, they're really investing in the gold market. They are purchasing gold to save it for future use as backing for their currency, which they will no longer have access to through the US dollar or US treasuries due to the probable depreciation of these assets. Furthermore, they are selling off their assets. Consequently, this will go on. However, I believe that interest from investors in gold and silver will continue to rise. Accordingly, I do not consider the highs set last week and earlier this week to be the highs. Those feelings are fleeting. By the end of the year, I would be astonished if we didn't get rid of those highs. We have plenty of room to climb even higher than those peaks. Due to the government shutdown, there is a dearth of economic news. The Federal Open Market Committee, FOMC, is scheduled to meet next week, which may trigger another surge in gold prices. Rate cuts from the Federal Reserve are widely anticipated. Even with today's news, it remains the case. At long last, official government economic data has arrived. Even though we're in the midst of a shutdown, it seems like they still push them to do this. The September CPI figures were revealed earlier today. While the anticipation was for a 0.4% increase, consumer prices fell short at 0.3%. Nonetheless, the fact that CPI is up 3% from the previous year is the more important figure. While that's a little lower than the 3.1% predicted by experts, it's still a 0.1% increase from last month. The increasing sequential number, however, is more important. We were at 2.9, we maintained our position at 2.9. Our level reached 3. The Federal Reserve has said that its target rate is 2. What do you think the Fed will do next if your objective is 2 and you're 50% above target and moving in the opposite direction, having risen from 2.9 to 3 in the past month? I mean, it sounds like a hike. When the stock market reaches new heights while inflation is 50% higher than target and continuing to rise. In other news, the S&P 500, the Dow Jones Industrial Average, and the Nasdaq Composite all reached fresh all-time highs today. The Dow actually closed above 47,000 for the first time ever today. To reiterate, this is an unadjusted nominal high, unaffected by inflation or the gold price. However, your stock values are at historic highs. There is gold worth $41 that you possess. You've got inflation that's 50% higher than objective and going up. The Federal Reserve ought to raise interest rates. Nevertheless, a cut is imminent from the Fed, and that's why the Fed will make a poor decision. That's why the markets, including gold, are where they are. We will observe the market's response. Meanwhile, you should seize this opportunity to buy gold at a discount. Nearly $4,400 was the highest price for gold. We've dropped below $400 by a few silver now. Since I do not anticipate it being below $50 for much longer, I believe that purchasing it at this price is a fantastic investment. I still think 50 will serve as support in the long run, even though we're trading below it right now. You saw the double top there. It has been removed. We've retreated at this point. I predict that it will soar much beyond 50 with the next move. As a result, silver is still reasonably priced. Proceed to sell gold. There are more than just shift gold videos on YouTube. Get in on the gold swapping action and, more significantly, ride out the 15% stock market slump in precious metals. With a floor of $4,000, gold is looking fantastic. Money will be printed by these miners. I see today's reaction to the Newmont news as nothing more than a buying opportunity inside the sector, and specifically within Newmont. A good moment to buy more and add to your positions is when others are selling their equities, because they are worried. You may have felt regret for not investing more capital when you watch these mining stocks really move, but your position size wasn't large enough to prevent you from missing out. Do not feel remorse at this moment. You are free to deposit the funds. A chance has presented itself to you in the market. Use it wisely. The mainstream narrative paints a drastically different picture of gold's most recent decline. From $4,000, the market did not retrace. The price dropped to $4,000, marking that amount as the new structural floor instead of resistance. This change signifies a major turning point in the long-term bull cycle of gold, showing that prices are becoming more stable above psychological levels that used to cause sell-offs. The mining stock market has taken a beating as gold has consolidated at current levels. Indices such as the GDX and GDXJ have fallen significantly despite record profitability for the industry as a whole. This disagreement highlights a larger miscommunication between investors and the financial press, who continue to interpret gold's performance via antiquated skeptical lenses instead of acknowledging the revolutionary shift taking place. The markets are still rooted in fear rather than exhilaration, which is characteristic of an early-stage bull market rather than a mania, even though earnings reports from big producers show profitability doubling year over year. The strength of gold above $4,000 appears less like a high and more like the beginning of a much larger revaluation as global monetary confidence keeps deteriorating. Please return to the interview. I believe the fact that we failed to correct from 4,000 is the most important part of the gold correction. We started the correction much higher than 4,000 and brought it down to 4,000. It's not like we had opposition at 4,000, as many might assume from such a large, round number. In most cases, you will encounter psychological resistance. At $2,000 gold, we had it. Even if it wasn't nearly as much as $2,000 gold, we still had it at $3,000. Still, many were anticipating that 4,000 would serve as a barrier that would trigger a retracement. The market might need some time to go over that level. Rather, we cut through it like butter with a hot knife. We did see a correction, but our decline brought us down to 4,000. 4,000 seems to be the new floor for silver's price. The gold mining corporations would be pleased to hear that 4,000 is the new floor for gold, but they shouldn't be emboldened by that. However, that fact would be completely concealed by observing the performance of such stocks. Despite silver's extremely high price of 48.5%, the GDX and GDXJ have fallen more than 20% from their respective highs in the past week, and it appears that nearly all silver stocks are currently experiencing a bear market. Moreover, I believe that silver stock purchasers should take heart from the fact that it was able to break through 50 and nearly reach 55, as this indicates that 50 is no longer the ceiling. I don't think we'll be able to maintain our current level below 50 for much longer, but we have passed it. I believe that 4,000 is the new 3,000. Now that we're back to talking about gold and numbers, you may remember that once we broke through $3,000 for gold, we briefly dipped below that level, but we quickly recovered. It was the floor, I swear. When you get to 4,000, you can expect the same thing to happen. Given how near it was to 4,016 earlier this week, I wouldn't be shocked if the market dropped back below 4,000 again. That might have been the lowest point. Perhaps the correction has reached its final stage. However, there's always the chance that this isn't the bottom, and the market will retest it before dropping even lower. This could be done to dissuade speculators who are buying now and setting stops below the current low, or even below 4,000. This would allow for a low-risk trade like this one. I'd buy gold at 4,100, but I'd sell if it dropped below 4,000. Something means that some people may do something and be unsuccessful. They might not, though. If we do drop below 4,000 again, it will be for a short period of time and likely solely to clear out those stops. After that, the market will likely rise again, so I really don't care. I believe we're going to reach new heights. The fact that gold broke beyond the $4,000 barrier is, in my opinion, extremely bullish. The media's portrayal of gold's rally, and more importantly, its decline, as the end of a speculative bubble is also quite positive in my opinion, especially when it comes to financial media. Actually, I was watching CNBC today, and they broke some news about GLD inflows. These inflows have been quite substantial over the past 4 months, which is in stark contrast to the massive outflows that occurred earlier this year and throughout last year.